For today's video, I am going to talk about a different topic, which is about the father of value investing, Benjamin Graham, and his investing masterpiece, The Intelligent Investor. Even Warren Buffett sees this book as the ultimate guide for starting an investing journey.
I've had some lucky days in my life, but one of the luckiest was in 1949 when I was 19 years old in Lincoln, Nebraska, and I picked up a copy of The Intelligent Investor.
So reading this book might just be the stepping stone people need to learn and understand the art of security analysis. The book is about value investing, a method of investing that Graham first taught in 1928 and later perfected with David Dodd. The book is so good that even Warren Buffett enrolled at Columbia Business School to study under Graham after reading The Intelligent Investor when he was 19 years old, and the two became lifelong friends.
I very belatedly applied to Columbia University, and Dave Dodd let me in, and I got to know Ben personally when he was my professor in the second semester there.
Buffett then worked for Graham for 2 years at his company, the Graham-Newman Corporation, until Graham chose to close the company and retire. Following that, many of Graham's clients approached Buffett and requested him to manage their money, and the rest is history. Buffett went on to establish his own method, which differed from Graham's, in that he placed a greater emphasis on the quality of an asset, and advocated for holding investments eternally. Instead, Graham would sell an investment when it reached a predetermined price. But, according to Buffett, no one has ever lost money following Graham's approach and counsel. Here are just 5 of the key lessons I took away from this masterwork. Graham lost most of his money in the stock market crash of 1929 and the Great Depression that followed. Graham learned a painful lesson about risk, but instead of quitting investing like many others, he wrote Security Analysis, which described his methodologies for analyzing and pricing assets. He achieved this by purchasing the stocks of companies whose shares were trading at a large discount to their liquidation value. Graham is claimed to have averaged roughly a 20% yearly return over his many years of money management, notwithstanding the hardships of the Great Depression.
A seminar at the Graduate School of Business at Columbia University. After all, it's older than the stock exchange. And we thought professors familiar with the language of the street might treat the market with detachment. Dean Courtney Brown and Professor Benjamin Graham were instructing future brokers and customers' men.
The explanation cannot be found in any mathematics, but it has to be found in investor psychology. You can have an extraordinary difference in the price level merely because not only speculators, but investors themselves.
Graham's success came at a time when investing in stocks was regarded as nothing more than gambling, but he was able to do so with high returns and low risk. Graham believed that investing should include the assurance of a return on investment on invested capital as well as a worthwhile return over the rate of inflation. His strategy was to challenge the commonly held belief that markets are efficient, instead promising to find undervalued assets. This is known as value investing. Mr. Market, an illogical person who graciously provides you a purchase and sell price for your assets every day, was introduced by Graham as a wonderful analogy. Mr. Market, unfortunately, is a manic-depressive character who, on some days, gives extremely exuberant or even outrageous prices, while on other days, he can only see doom and gloom, and offers crazily depressed prices. Graham argued that as an investor, you have the option of following Mr. Market's leads, or even ignoring him. He explained that the key is to regard Mr. Market as an ally, and to take advantage of his generous offer of regular rates. When he's depressed, buy, and when he's on a high, sell your stocks.
Looking at the situation through rose-colored glasses rather than dark blue glasses. It may well be true that the underlying psychology of the American people has not changed so much, and that what the American people have been waiting for many years has been an excuse for going back to the speculative attitudes which used to characterize them from time to time. If history counts for anything, that the stock market is much more likely than not to advance to a point where of real danger.
Graham consistently emphasized the importance of buying investments with a margin of safety and at a discount to their true or intrinsic worth. This is significant because it enables for upside profit as the market revalues the item to its true value. However, if things don't go as planned and the market takes a turn for the worst, the margin of safety method provides some protection on the downside. In the case of stocks, Graham would consider a company's liquidation value. To mitigate negative risk in real estate, investors could consider land value and cost of construction, for example.
Famous lesson about a margin of safety, that you don't drive a truck that weighs 9,900 pounds across a bridge that says limit 10,000 pounds, because you can't be that sure about it. If you see something like that, you go down a little further down the road and you find one that says limit 20,000 pounds, and that's the one you drive across.
The basic concept of value investing is to purchase assets at a discount to their true value, and keep them until their price rises to their full value, earning a profit on the investment. Graham indicated that his goal was to purchase $1 worth of assets for 50 cents, and he was successful in doing so. He had two options for accomplishing this. The use of market psychology was the first method. That is, he takes advantage of the market's fear and greed. The second strategy was to invest by the numbers in order to locate undervalued assets by investing counter-cyclically when the market was down and bargains were plentiful.
And taking the consensus of expert opinion. And the results are just about the same in each case. Your question as to why they are not more dependable is a very good one and an interesting one. And my own explanation for that is this, that everybody in Wall Street is so smart, see, that their brilliance offsets each other.
The market is a voting machine in the near term. It is a weighing mechanism in the long run, Graham says. There will always be Chicken Littles who will tell you that the sky is falling, and that now is a horrible time to invest. We have no means of knowing what markets will do in the short term. The market, on the other hand, will revert to the mean and represent intrinsic value in the long run. Find assets that will be in high demand in the long run, purchase them, and hold them. In a word, this is what sensible investing is all about. With that, I hope you guys able to get the important lessons from the value investing father Benjamin Graham. And if you guys are planning to buy this book, unfortunately I am unable to get Amazon affiliate program, the reason being that Amazon does not do business in my home country. So you guys need to manually go to Amazon.com to buy the book if you are interested. With this, I will end the video. Business Wisdom, signing out.